welcome back. So, let us start with the topic that we were talking about, the financial crisis. So, the topic we were discussing, it talked about how we can understand the origin and the consequences of the financial crisis. So, the brief outline will remain same. So, we talked about the how management of financial innovations, asset price boom and bust create the heightened uncertainty scenario in the economy, and this leads to the failure of financial institutions. The appropriate word would be the spread of the systemic risk in the financial the first stage of the financial crisis. Now, we will be moving to stage 2, stage 3. So, here the reference point remains same. So, here we have the Williamson and the Mishkin that I have referred. We are discussing from the Mishkin, and the brief outline it remains same, that we are first trying to understand the financial crisis, origin and consequences, then 2007-8 financial crisis and David and Davies model of the bank runs. So, we were discussing about the financial crisis, and we mentioned that in a stage 1 the mismanagement of financial liberalization innovation create the scenario or sets the platform for the financial crisis. Then you have the asset price booms and bust, a general increase in uncertainty caused by failure of major financial institutions. So, these we have discussed already. Then here we have the origin of a banking crisis. So, once we have the first stage passed, then or once we have crossed the first stage, then we enter into the second stage. In second stage, we have something called the origin of the banking crisis, and this banking crisis is having the several dimensions to look at. One is about the bank panic, in the sense that when in the stage 1 the banks are giving money to the businessmen, individuals, right. So, they are creating or going for credit creation for most of the household firms and the rest of the segment. So, you can assume, and once they see that they do not have sufficient recovery of those sanctioned loans or the disbursed money, and the borrowers are not paying on time, which means that this will deteriorate the financial health of the banks. And this financial health deterioration, what we call it as in the form, in the technical term, balance sheet deterioration, because for the bank, the deposit that you keep, when you keep money in the bank is supposed to pay rate of interest on your deposit, right. So, it is some kind of liability for the bank, but when you have the loan account with the bank, then bank is supposed to get extra money in the form of interest money from you, right, for the sanction amount. So, it becomes an asset. So, the moment you have a more of on deposit, they do not have control. Whosoever wants to go and they fulfill the criteria, open the account, deposit money, banks will have that money, and after meeting the reserve requirement, they are allowed to lend the money, right. So, they will be lending to somebody, but if they face difficulty from the asset side, which means that if from the asset side, if they are not receiving sufficient amount of money or the disbursed amount of money is not recovered fully, then this creates a panic among the banks that they will have deterioration in their balance sheet. So, in case of India also we experienced the similar kind of scenario, that when we had the higher investment scenarios, when we had gone for making higher investment in certain sectors, certain activities, and when we allowed the banks to finance those activities, bank helped the firms and financed, but they did not receive the similar kind of return of the money, and this created trouble for the banks. So, in the literature that they call it as the balance sheet crisis, but here we try to understand in this dimension. Allow firms to declare insolvency, higher loan defaults, then here you have the bank panic when multiple institutions fail simultaneously. So, suppose you have 20 firms operating, out of these 20 firms, almost 18 firms had approached the banks, bank sanctioned the money. Out of these 18, only 10 are having the good payment record, or suppose out of this 18, almost 12 had the good payment record, but because of the asset price boom and bust and that we mentioned, these firms started getting or started feeling the hit of the market and resulting in their net income losses, and they were not, and they did not pay or they did not deposit the money to the bank, or they did not clear the loan to the bank. So, bank is having now what we call it as the non performing assets on their balance sheet. Once it accumulates, then it creates a very adverse scenario for the banking sector. So, here what typically happens that once we have the balance sheet deterioration. So, the first thing, the asset price boom and bust will start, that you will have the declaration of insolvency by the firms, and if the firms are going for declaring insolvency, it means that banks will not receive the amount. So, this will impact the banking sector, which what we call it as the higher loan defaults. Let us focus on here. If it spreads to other banking sector also, then what we call it as the, when multiple institutions fail simultaneously, then what we have, we call it the bank panic. The market asymmetry creates fear among depositors, and whether banks will allow them to withdraw their money or not. So, even depositors, so if the banks are making huge losses, if they are also going for insolvency, then it becomes really tough for the lenders, that if you have deposited money with the bank, then you feel that you will not be able to withdraw, and that is what, when you see that you have people standing outside for withdrawal and even the bank will not allow, then this creates further risk or adds a risk scenario to the economy, especially to the banking sector. And when you have a panic, if you have the bank panic, then what typically happens, that even retail investors will be worried about the withdrawal of their money, the deposit money, then there it becomes really important. Banks sell off their assets quickly to raise the necessary fund. So, they are there. These fire sales of the asset may cause their prices to decline so much that the bank becomes insolvent. So, here first thing is that because of the deterioration in the banking sector, because of the business deterioration or the moderate business outlook, what we see is that you have the balance sheet deterioration, insolvency declaration by firms. This leads to higher loan defaults, and these bank panic and the withdrawal of money create trouble, and even banks after some time become insolvent. So, this is what we mentioned about. Severe adverse selection and moral hazard problems reduce the investment in productive activities, increasing uncertainty in the economy. So, if you have such type of scenarios where the firms are also finding it difficult to invest, banks, since they are dependent upon the funds, banks are also finding it difficult to survive. So, if you have insolvency acceptance by both or declaration by both firm and bank, then of course, this is going to badly impact your investment scenarios, and this may have the full fledged the financial crisis. So, this is what we have the stage 2 scenarios. In a stage 2 scenario, this is what we look at. So, in case of India, in case of US, this can be linked with what we had the scenario of the housing market crash, and then we had the scenario in India in 2016-17, that in 2018 the banking sector shock had spread to the non-banking financial crisis. Even the real estate companies were engulfed in this, and then we had the full fledged the crisis. The further domestic developments also were responsible for that. Then the stage 3 talks about the debt deflation. What is the meaning of debt deflation? Debt deflation occurs when a substantial unanticipated decline in price level sets in, leading to a further deterioration in firm's net worth because of the increased burden of indebtedness, in the sense that debt deflation happens when you have the less demand, more of supply. So, price will be lower, and once the price will be lower, then it matters for the firm because their earnings are going to be lower, and if they are supposed to make payments, so from the payment side. So, we know that if you have the inflation higher, then it is the loss for the debtor, gain for the borrower, because borrower feel that it is in real terms it will have to pay less. But if you have the inflation or the price level lower, then it is for the lender it is good, for borrower it is not good. So, this is what we call it. But debt deflation has a widespread impact on the economy, because it not just includes the demand supply scenario, it will also have the impact on the interest rate scenario, it will also have impact on the employment. Firms may not find it to employ more labor, less of matching efficiency. So, the search theory that we discussed, less of matching inefficiency, low value of labor market tightness. So, all these factors will play important role. Real net worth in the sense that your value of the firm was $100 billion suppose, and you had the debt of around $90 billion. Because of the price fall, so the debt value remains same. So, rather it goes up. So, you may be having the $10 billion of worth of your value, but because of the price decline it shoots up further. So, it goes to $99 billion in terms of the indebtedness. So, if you have this is what it means, that if a price lower, your indebtedness goes up. So, your actual now net worth will be around just $1 billion. So, this is what it means. It also means that if you have the exchange rate also depreciating. So, in most of the cases what we see is that some of the firms, when they go for the external commercial borrowing, which means that they borrow from outside market, if the exchange rate is favorable. So, for example, in case of India also we saw that some of the firms, when we were having in a very I would say comfortable situation, at that time the exchange rate was much higher, or I would say exchange rate was much higher in the sense that rupee was stronger. So, as compared to what we see the exchange rate of 74 rupees, at that time the exchange rate was around 48 rupees per dollar. So, at that time firms borrowed money from outside market by listing or from the financial institutions, but when the rupee started depreciating, then this created additional cost to the firms operating in India. So, you have to earn rupee and you have to make payment in dollar terms. So, if rupee is depreciating further, this adds an extra cost to the firm, because now you are clearing at 48 rupees per dollar, but now you have to clear the loan at 74 rupees or 68 rupees. So, the difference of 48 and 68 is not because of you, it is because of the economy and because of the functioning of the economy. So, there you have to keep in mind these things. Lending and economic activity decline for a long time. So, this is what we mentioned about. Let us talk about the US financial crisis, how we can think about the US financial crisis. So, here you have the three central factors we always mention about the 2007-9 global financial crisis. First is the financial innovation in the mortgage market. In the US, when you talk about the mortgage market, it means about the buying and selling of real estate housing. So, agency problem in the mortgage market, some of the financial institutions or the institutions which were involved in the mortgage financing, they were not very serious. So, they had gone for over promising things, and that created further trouble. The role of asymmetric information in credit rating process, which means that even in the rating of the firms, certain irregularities were observed. So, if you think about all these things, then it matters. So, let us talk one by one. One, you have the financial innovation in mortgage market. Here financial innovation, as we have mentioned, the stage 1. So, we are talking about a stage 1 here. We saw that post 2000 we saw the internet penetration in most of the economic activities, and financial sector was the most advanced sector with regard to the internet penetration. Internet penetration also helped the firms to trade different types of complex instruments, which means that you can innovate the product and sell to investors, and even investors will be deciding about how much loss or gain they are making. If they are making good profits, it will be conveyed to everyone, and this product will become popular. So, a lot of such type of product started coming with regard to credit risk. And so, in the US earlier only the prime borrowers were allowed, but because of the housing boom, even the subprime borrowers were allowed to borrow money for residential mortgage market. The computer technology enabled the bundling together of a smaller loans like mortgages into standard debt securities, what we call it as the So securitization of different types of financial assets started. So earlier it was only equity, and then we saw that post 2000 we had financialization of major commodities, even commodities, and then we saw the different types of loan instruments to be clubbed into a financial instrument and getting traded. So those things started. So securitization started, which also what we call it the financialization. The subprime mortgages to borrowers with less than the stellar credit records, right. So the loans were sanctioned. Mortgage backed securities were launched as standardized debt security, right. Then the development of structured credit products such as CDOs were also launched. The mortgage backed security, in the sense that the financial institutions, they club the a particular type of loan and they sell it to the financial institutions. Financial institutions will further develop the contract and selling it to the investors. Investors will be getting the return, but you will not be getting the principal payment, you will be just getting the interest and principal during at the time. After the maturity, you will not be getting anything. But this also created an opportunity for the financial market to innovate and the sell such product. Then we saw that we had the collateral debt obligations, collateralized debt obligations also coming as CDOs, and CDOs played also very important role. So these two instruments are often cited one of the prime reasons for the occurrence of the global financial crisis. Agency problem, let us highlight the agency problem. So here what was the reason? Originate to distribute business model was exposed to principal agent problem, in which the mortgage brokers acted as an agent. They did not act as the facilitator, which means that their incentives were attached to the sellings, that how many units of or how many times you are selling the product to the investors, then based on that your incentive will be attached. So if you are selling one product, your incentive is $100, but if you are selling 10 product, your incentive is 1,000, not just 1,000, $1,200. Now if the individual's objective or the target is given that how many products are you selling, then of course this particular individual may be going for overselling, which means that some of the clauses are not being covered, but this particular person is over promising. So over promising thing started. In case of India, we have gone for revision after 2007-9 global financial crisis. Sri Krishna committee had given a particular detailed report. Under that we have gone for revision, what we call it the Indian Financial Code, and then we have devised certain norms to tackle such type of agency problem in different segments of the financial sector across even the urban and suburban areas. So it started with the US financial crisis. Once the mortgage broker earns his or her fee, why should the broker care if the borrower makes good or his or her payment? So they have just sold to the households and they purchased also, but this purchase, whether it is worth for the financial institution, that became a major concern. And it later, when these households were not able to repay, then it later acted as a major shocker to most of the financial institutions. So here what we call it the financial institutions, what we have mentioned here. Commercial and investment banks who were earning large fees by underwriting mortgage backed securities and structured credit CDOs also had weak incentives to make sure that the holders of the securities are paid off, which means that even the large financial institutions which were involved in facilitation of such complex instruments, they were also not very aware that how these particular products are going to function. So you can think about US financial crisis was not because of the financial innovation itself, it was also because of the agency problem. In the third state, we know that how it led to the defaults of major financial institutions in the US. Lehman Brothers episode, we all remember that how it created a big havoc on the financial market. Even the major stock markets had a major fall, and then since these are the complex instruments, so underlying assets and you have the cross border investment also happening. So these instruments further had a very severe impact on the financial sectors across the globe. It also spread to the European market, where we saw a major decline in asset prices. So this is what we often mentioned about the US financial crisis. Now we will be moving towards a financial intermediary, and we will be trying to see that how do we decide about the bank run. So, now the financial crisis part we have covered. Now, we are going to see that how do you decide about the financial intermediary, what are the role of financial intermediary. Financial intermediary, if I am saying, then I am saying about the NBFCs, the banks and the related institutions which accept the deposit and go for lending. So, borrow from one group of economic agents and lend to another, well diversified with respect to both asset and liabilities, transform assets, process information. So, this is what we have, right. The diamond and the big banking model. So, regarding the banking sector, how the banks fail. So, the very detailed account of the bank failure is being handled by the diamond and the big model, and under the banking model it was developed in during 1980s and it became popular after that, but then people did not pay that much attention. But when we saw the failure of banks in major economy, then we started looking back and then we started examining it. The model helps us understand some features of the bank and explains why bank run might occur, what should be the approach of the government and how we can prevent it, right. So, the diamond DB model, if you try and understand, so we call it as the DD model also. When individuals, when they are in a fear that if they are being left out and if they are not allowed, or if they are reaching late to the bank and if their participation rate is low, then in the event of any uncertainty, when we have the shock, then it may happen that all the depositors would like to withdraw money at the same time. So, if you have a higher withdrawal of money than the deposit in the banking sector, then the bank will have to sell some assets to meet the requirement of deposits. If the banks are selling, that is, we call it the liquidation. If liquidation process continues for some time, then this will lead to a bank run kind of scenario. If you have the perfect competitive market where different types of banks are participating, then it may also happen that you may incur a situation where you will have a difficulty in I would say retaining your banking sector profit. So, bank may not be getting that much amount of income to sustain in the market. So, if this process continues for some more time, you will have, for sure you will have the bank run. So, as I mentioned that if banks are designating an individual that you will be part of your borrowing up to this point, not beyond this, and if everyone reaches at the same time, because the person who is going late to the bank, he feels that the person who are going early, they may be withdrawing more. So, it is better that I should be also reaching. So, that is what their underlying idea tells. If a depositor gets to the bank too late, she gets nothing. So, this is what we have. A late consumer knows that if everyone runs to the bank and requests withdrawal, they will be having nothing to withdraw, right, and it is optimal to run if everyone else does. Right here, what they say that here how the bank runs becomes a case for the other banks also, because if this process gets repeated for other banks also, then in that case it will create a bank run for most of the banks. And that is what we see, that we have any shock to the banking sector is taken seriously by the government, because central bank, because then it becomes really important. If all depositors show up to the bank in anticipation that bank will fail, then their expectations are self-fulfilling and bank will indeed fail. Now, here what we see is that in the Diamond DB model, one of the important contribution is that how we can tackle the bank run. So, one solution or remedy that they provide is that if the government is going for deposit insurance, then this will lead to some kind of assurance to the depositor and also to the banking, that they even if they go for liquidation, the depositors are safe. But this will further create one more scenario, will be about the moral hazard, that whether whether the bank will utilize the opportunity, because if they feel that the deposit is insured, then they will be making the risky investment, right. So, if they are making the risky investment, then this will further create trouble. So, earlier the it was withdrawal that was leading to the bank run, but with the deposit insurance there is highly likely that the banks will not pay much attention for the business activity. In India, we have Deposit Insurance and Credit Guarantee Corporation DICGC, which provides the coverage against the failure. So, it provides about 98% of the bank accounts. The amount of insurance is about 5 lakh per account insurance cover. So, this is what we try to cover in this, and let me summarize what we have done. So, we have covered the financial crisis origin. We have also covered the Diamond-Dewey model. If you want to read more about it, so you can read from the Williamson, there they have very good interpretation of this. And then we understood that if the government is providing deposit insurance, then this may act as a potential savior against the bank run, but then moral hazard becomes a major issue. So, with this I will be concluding the session, and thank you so much for your attention. In the next session we will be talking about the international trade and certain dimensions. So, I am stopping it here. Thank you.